Hey, YouTube family, aka homies and homettes. Welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about in the first quarter of this year, in aggregate, home equity took a big hit, over 100 billion. Yes, it is market to market dependent, but overall, in the first quarter of this year, $100 billion worth of equity was lost across the United States. We're going to talk about this. Stick to the end of this video where I'm going to show you a map that shows you where equity was lost, where equity was gained, and more importantly, what state overall lost the most equity out of any other state in the country. So I am your host, Kevin Strong. If you're new to my show, welcome. Please start off by smashing that like button, commenting and share because I care. Please share my videos. I do appreciate those guys who come out and support my channel. So without further ado, let's go ahead and get into this. Okay, so we're going to talk about this. U.S. mortgage holders saw their home equity decline for the first time in over a decade. So once again, we're starting to get some information, guys, that kind of reflects back to what was happening during the great financial crisis from 2008 to 2012. The first bullet point on this slide says that the average mortgage borrower saw home equity decline by $5,400, or a little bit more than 0.5% annually in the first quarter of this year. Now, this stat is coming from CoreLogic, which is a very well-respected research firm, as it does a lot of analysis and statistics as it relates to the housing market. Second point says collectively, property owners lost $108.4 billion with a B in home value, aka equity. The first equity loss since 2012. So just for a quick history lesson, when the great financial crisis was really in full swing around, I think, the fall of 2008, beginning of 2009, overall as a country, we really didn't come out of that until around 2012. So it's somewhat ominous that this particular research is referring back to the first equity loss since 2012. So very ominous trend. Year over year, however, the number of homes in negative equity increased by 4% from 1.1 million homes, or 2% of all mortgaged property. So overall, there's still a lot of people out there that have a ton of equity. I'm not trying to say that's not the case, but as I've said in previous videos, if you had a low down payment program, aka FHA or VA, and you bought at the top of this market within the last 24 to 36 months, you could be in a market where you're already upside down, aka you don't have any equity in your property. So the last point says in the first quarter of this year, 145,000 homes would regain equity if home prices rose by 5%. So that leads to my point. It's definitely market dependent, but if the home price declines by 5%, 213,000 properties would fall underwater. In my humble opinion, as a licensed real estate agent in the state of Washington and a licensed mortgage officer in Washington, and I believe in Maine's the other state, I think for a lot of the bigger markets that just went up astronomically, and the map will kind of show you that once you stick around to the end of the video, those are the markets that are going to get hit the hardest. Some of the more Midwestern markets probably going to see some pullback, but it won't be as remotely as devastating as it will be for some of the bigger markets. So it's not just the payment. I think this is something that's really getting a lot of people in trouble. A lot of times, you'll go get pre-qualified for a mortgage. You and your significant other are very excited about the biggest transaction of your life. Why you would waive your inspections and appraisals like some of the people are doing during the pandemic makes absolutely no sense. It's ASA 9, ASA 10, ASA 11, ASA 12. But getting back to our regular scheduled programming, what I mean by it's not just the payment. A lot of times if you pre-qualify, let's say the lender says, hey, you can go up to 600,000. you know you're going to get a $600,000 house. How many people get a pre-approved mortgage letter for $600,000? Look at their significant other and say, hey, you know, there's some ancillary costs like food, energy, things that I have on this slide here, property taxes. Let's leave a little cushion in our budget for unexpected fixed costs. So instead of going out and purchasing that home that we got pre-approved for $600,000, let's scale it back to like $450,000 or $500,000 just to give ourselves a little bit of breathing room. Most people don't have that type of financial self-discipline. They just don't. So as a result, I'm sure you're hearing these stories about Florida raising homeowners insurance. A lot of insurance companies are pulling out of Florida. A lot of insurance companies are pulling out of California. I think this will continue to be a nationwide trend. And if those insurance companies who are not pulling out of specific markets, they will continue to increase the cost to do business with them as inflation continues to be a problem. One sale, as you can see at the last bullet point on this slide, one distressed sale will set up a lower price point. This is what I mean. The analogy I like to give people is that you can do everything right. You can be driving your car at a traffic light. The light is basically red. You've got your hand tended to, you got your seatbelt on, and then somebody rear ends you, and then it could basically just change your life forever. You can have your financial house in order, pay all your bills, keep your house up, maintain the maintenance in the property. But if people around in your area who have homes that are comparable to you start losing their jobs or overextended themselves, and as a result, they have to do what's called a distress sale. They have to sell their property well below market value. That's going to create what's called the new baseline, right? If you have a 3-bedroom, 2-bath house, and let's say it's 2,500 square feet, just as hypothetical now, and let's say that the prevailing market rate is $600,000 for your home. Someone's got a comparable 2 bedrooms, same square footage, and all of a sudden they have to sell theirs for $520,000. What do you think the new sales price is based on the most recent comp? $520,000. Your house is no longer worth $600,000. So you've just lost $80,000 because, like I said, only one distressed sale. That's all it takes to set up a new lower price point for your given area. And without further ado, here's the map. I'm sorry if you guys can't kind of see this a little bit better, but basically on the West Coast is where you've seen the equity in aggregate. Those states have lost the most equity compared to, let's say, states in the Midwest, and the ones in red are basically have done very well. Florida is still relatively hot, although there's some areas down there that's starting to cool off. California lost about $60,000 in equity in aggregate. Overall, I'm sure there's some markets within the state of California that's doing well or doing okay, but this is taking everything in consideration within that state. And guess who is number one? Guess who's the bride of Frankenstein? Yours truly, the state of Washington, at $74,000. So the state of Washington, on average, has lost $74,000 worth of equity. That's 23% higher than California, which is at $60,000. So once again, I'm the guy that doesn't know what the hell he's talking about. So are there deals in Washington? Absolutely. Are there deals in Washington where people are still paying over asking price? Yes. But once again, this is taking everything in consideration. Places like the state of California and the state of Washington are very, very, very predicated on a tech industry. So as that industry continues to lay off and these high-paying jobs are hard to come by, you're going to see a lot of people in those markets selling their homes in a distressed situation. And as I said previously in my video, a distressed sale, only one, that's all it takes to basically reset your price point. So it's official. In most of U.S. Cities, it's actually cheaper to rent now than to buy. And that's the case in 45 out of 50 populous U.S. cities. So a lot of guys and gals who've decided to wait on the sideline a little bit and decide to say, hey, I'm not going to buy right now. I'm going to continue to stack my cash. If you're in a precarious employment situation where you're unsure about your job, please, please, please do not buy a home at this point in time. Lock into a 12-month lease. Do not get into a month-to-month because you don't have any stability that way. Unless you're really, really, really comfortable with moving on the fly. So I think it's going to be interesting to see how things play out. The commercial real estate market, which is something I'm basically getting involved in now, is headed for a lot of headwind. Office space, even multifamily in the Seattle area has a lot, and I do mean a ton of loans that have to be reset or refinanced between now and 2025. And those loans were taken out years ago at much, much more attractive cap rates and interest rates. So hell to pay in the greater Seattle area regarding commercial real estate. And I think the residential side is not far behind. So I hope you got this video. I hope you got some really good information out this video. Once again, if you're new to my channel, please smash that like button, hit that notification button so you are notified when I do decide to do my videos, which is typically once a week. I'm going to leave you with my famous quote: keep your credit score up and your debt down. This was the Kevin Strong Show, and I'll see you guys in the next video.